What is going on, friends? This is Matt Carter, that YouTube Realtor, and thanks for joining me today. I'm going to be going over a topic that is probably on a lot of people's mind if you're looking in getting into the market or if you're in the market already. It's been a pretty hot topic in the last little while, and it's what the mortgage rates are going to be doing in the next year and into 2023 as well. So I'm going to go over some of the basics about where those rates, what they mean, what impact they're going to have, and just some take-home messages for you if you're looking to make a move over the next year or two. So first off, let's get into what a couple of definitions of things we're going to talk about today. And the first is going to be what's called the overnight rate. So this one you probably hear a lot about in the news, and it's the rate that everybody's talking about that's going to be going up in the next little while, but it's not really the one that's going to affect you too much. So the overnight rate is the rate at which banks lend between themselves and the interest rate that they charge amongst themselves. So directly, that's not going to affect you right away, but the one that you're going to be more interested in is going to be that prime rate. So the prime rate is separate from the overnight rate, but pretty much follows it to a T, is usually about 2 to 2.5% above what the overnight rate is. So if that overnight rate is going to go up by, 0.25% or 0.5%, the prime rate is going to follow suit as well. This prime rate is going to what you're going to associate with a lot of things in the lending that consumers are going to be doing in the public. So it's really tightly associated with mortgage rates, home equity line of credits if you're taking things out of that, and some other loans that you're going to get from lenders. But the two that we're most interested in right now is going to be the mortgage rates and equity lines of credit. So why do these rates change? So there's generally two ways things are going to go, either up or down. What we've seen in the last couple of years, especially since the pandemic started, the government and the banks really wanted to incentivize spending, really wanted to kind of kickstart the economy, get money flowing into the country. So what they did was they decreased those rates in order to increase the lending power that people had. And basically that's the old adage of right now, money's really cheap. So interest rates are really low, incentivizing people to get out there, getting those loans from lenders, buying houses, getting a little bit more money on their credit cards, things of that nature, or taking money out of their house in order to make some certain investments, which will push money into the economy. On the flip side, if the government wants to stop spending so much, and what we're kind of seeing right now, inflation is getting pretty high, so they want to slow things down a little bit. What they'll do is do the inverse of what I just spoke about. They'll increase those rates, which will increase the amount of interest that you're going to have to pay on these loans, and ultimately just kind of dampen the spending that's going to be happening a little bit overall. So how do these rates affect mortgages? So like I said, when the overnight rate goes up, the prime rate is going to follow suit shortly after, generally at the same time it happens. So what's going to happen is, the lower the interest rates are, the more mortgage people are going to be able to take on in terms of their lending power from the banks and other lenders that they're borrowing money from. So therefore, the amount of money that you're getting from them is going to be greater, as well as the amount of interest that you're going to be paying is going to be less. So currently at the time of making this video, we're in the middle of February, getting into the second half of February right now. The overnight rate is at 0.25%. And we've heard a lot of rumblings from the Bank of Canada, a lot of the big banks in the country, what's going to happen to those rates over the next year and into 2023 as well. So we just passed the beginning of the month. They were supposed to have a rate hike of 0.25%. The Bank of Canada decided to forego that and push it off a little bit further down the road. But they're still anticipating an overall 1% hike in that overnight rate by the end of the year, as well as a 0.75% rate hike over 2023. And with some new evaluations coming in, and that might even be higher or moved up, the timeline might be moved up a little bit more, so it's more than 1% by the end of this year. So what does this mean for anybody looking to get into the housing market or is already in a housing market and owns a house? So for a fixed rate mortgage, if you've already purchased a house at a fixed rate, it's not really going to impact you too much. Usually that rate is good for 5 years at a fixed rate, depending on what your contract says with your lender, but generally speaking, 5 years is the term. So depending where you are in that term, you're going to be totally fine until that comes up. And then at which point you're going to have to renegotiate your current mortgage if you're going to stay in the same house, or if you're going to move into something else, you'll need to get a new rate as well. So there's nothing going to be a direct impact for those people with fixed rates. Even if they are going to get into the market with a fixed rate, once you have that locked in, you're good for your term. You don't have to worry about any variations in the rates going on. You're good at the percentage that you've agreed upon at the beginning of that contract. For those of you with a variable rate mortgage or who haven't got into the market yet and are going to get a variable rate mortgage, variable rates are generally lower than what a fixed rate is because it's a little more volatile and you're kind of riding the risk associated with the rates that are going on with within the country. So right now, the variable rate is generally about prime rate minus 0.45%. So you're going to be paying less than somebody with a fixed rate mortgage, but you're going to be more at risk with those rates fluctuating over the months and over the years. So if, like I talked about, if that prime rate is going to be going up by, a percentage to a percentage and a half over the next year and a half, then your variable mortgage is going to increase as well over that period of time. So I can't really speak to exactly how much that is going to increase your payments over the next little while. It really depends on the current rate that you have and the price point at which you purchased and the mortgage amount that you have through your lender. But on average, if you're looking in the city of London, you're going to be looking at about, for every 0.25 percentage increase, you're going to be looking at about $40 more a month. So it's not too bad in the short term, but if you look at the big picture, if we're going up by that, 1 to 1.5, maybe up into the 2% increase over the next 2 years, it really is going to build on your monthly mortgage payments. If it's $40 a month, you're going to be looking at, maybe by the time it's all said and done, an extra $3 to $350 a month on your mortgage. So for the new buyers out there, people looking to get into the market, if you're worried about these mortgage or these rates increasing and affecting you, you might not be impacted as soon as you may think. So currently, when you go to get pre-qualified for a mortgage, a lot of people think that you're getting qualified at the rate that you're going to be getting lent at, and that's not necessarily true. So a lot of the times you're going to be qualifying at a higher interest rate than what you're going to be receiving from that lender. And this is what's called a stress test. This is in place in order to protect both you and the bank for any fluctuations like we are going to be seeing, to make sure that you can afford your payments in the future if the interest rates do go up. So right now, the stress test is set at 5.25%, or whatever your whatever prime is plus 2%, whichever one is higher. So right now we're at 5.25 because that would be higher than what prime plus 2% would be at the moment. So assuming that you're getting quoted the best rate that you can get right now for a fixed mortgage, you still have quite a bit of wiggle room before that starts impacting what your overall lending power is going to be and what your pre-qualification and pre-approval is going to be at the end of the day. So right now you can probably afford between a 0.5 to 1% increase in those prime rates before it starts to affect the actual dollar amount that you're going to be able to get lent from your lender. It will impact your overall monthly mortgage payment, but the overall dollar amount which they're going to give you towards your mortgage won't change until we start seeing that prime rate creep up to the 1 to 2% increase from where we are right now. So in this year, 2022, big banks are kind of expecting that we're going to see a drop off in home sales from anywhere from 8 to 20%. I know that's a pretty big range. And also that home prices are still going to increase, but at a rate of anywhere between 3 and 10%. This is pretty different compared to what we've seen in the last couple of years, especially in the London region. We've been seeing increases of about 20% when historically we're seeing, a 3 to a 5% increase year over year. So it's been pretty crazy the last little while. So the big banks are hoping that these increases in rates, in your mortgage rates, are going to have an impact, slow down the housing market a little bit, and hopefully dampen all the buying pressure that is out there in order to curb the vast increases in prices of an average priced home, not only in where I am in London, but it's in largely across North America as well. So my final thoughts and takeaways from everything that we're seeing coming down the pipeline is this is probably going to make a difference in the long run, but I don't think we're going to see any impact of it short term over the next 6 months or so. It's not going to be until the end of the year and into 2023 that we're going to really see the impact of these increases of rates increasing, just because they take a little while for them to come into effect and actually impact the day-to-day buying of everybody that's in the market. So right now, if you go to your mortgage lender and you get locked in for a pre-approval at a certain interest rate that you're going to be lending on, that's usually locked in for about 4 months. So that means you could go today and get an interest rate of, let's say 3%, 2.99% on a fixed rate mortgage. You're going to be set to go for the next 4 months of searching for a home. So if that if the interest rate increases over the next 4 months, you're still going to be good with your 2.99. It's not going to be until that pre-approval expires that you're going to have to go get a new interest rate quote, and then that will be at the higher rate than it currently was. So, and I think this is kind of largely why we're seeing such crazy activity in the market right now. If you take a look at my last market update, homes are going an insane amount over the asking price. The average price of a home in London is up an incredible amount over since last year in December. So I think what a lot of people are doing, they're going in, getting these interest rates locked in. They're finding a home, getting that interest rate locked in for their fixed rate term in order to avoid any increases in those rates that are coming down the pipeline. So like I said, the Bank of Canada has already kind of kicked the can down the road once by not increasing the rate last month, but it's definitely coming. It's definitely going to be coming over the next couple months. So if you are in a situation where you're looking to purchase, maybe go and get that interest rate locked in so you can buy something. But again, like I said, it's not going to impact you too greatly in the short term. It's going to be a longer term effect for that. So don't feel like you need to jump on something right now. That's what a lot of people are doing, and that's why it's going crazy. So take your time, make sure you're not rushing into something that you don't need to be, because in the end, it's going to be a better decision for you and your family if you're looking for something that fits you more personally, rather than just jumping into something right now in order to get into it. So that's about it. Hopefully you enjoyed the content today and found some value in it. If you did, make sure you pass it along to anybody that you think would value from it as well. And if you could do me a favor, YouTube really likes that when you do these things. Hit that like button, subscribe, hit that notification bell so you get notified for all my videos that come up every week. And until my next video, take care.